Welcome back to another episode of Policy and Profits. I'm EJ Antoni. I play an economist on TV, but more importantly, I am joined by the one, the only trader extraordinaire, founder of Ascalon 6 Capital, Anthony Esposito. Anthony, how's your week been?
EJ, week's going well. Week is going well. It's been, every year I've been trading for 29 years now. Every year you turn, you talk about December starting in September, and we've made the turn. It's gotten a little quiet from the guys I speak to on the trading desk on the sell side. So it's been a good week. December's here. Everyone's kind of talks about the seasonal bias to the upside, which generally is true. Things get quiet. Everyone's focused on their bonus numbers, the year-end numbers, the P&L, trying to keep that watermark where it should be and get paid out. So kind of seems to be the word on the street from everyone I'm speaking to. Obviously, we launched the new fund, Ascalon 6, on January 1st. So we're in prep phase, operational items, finishing up with the investors out west and down south, and kind of moving towards that. So I've been busy, but a good busy. We're kind of well positioned and under control. The market, the news, that's another. Washington, D.C., geopolitically, globally, that's another question, but everything's been good here. How are you doing? You've been doing a lot of travel, and I see you across the board. You were actually hosting Fox Business the other day, which I thought was pretty interesting. What's going on?
Yeah, up in New York City quite a bit these days. So bouncing a lot back and forth between there and DC. A little bit in Philly. We've got Palm Beach coming up for an event down there. So yeah, feel like a pinball a little bit. Kind of bouncing all over the place here. I need some consistency in my life. Actually, speaking of consistency, real quick, if I can, to get back to something you were just talking about, that Santa Claus rally. How consistent is that?
It's been, generally speaking, I don't have the numbers right in front of me, but generally speaking, there's a positive bias to December. We have seen some real drawdowns in December, which people quickly forget. I think 2016 was the last of the last 10 years, the roughest one that we've seen. I want to say we were down 5 or 6% in that 2016 December. I believe, don't hold me to it, but generally speaking, December is quiet with an upward bias because of the fact that people generally are being paid out on performance. They are generally long. So the idea is I'm not going to be dumping positions, losing positions, or pressing anything, because of the fact that the higher things close in general, the more people will get paid. And people meaning the street. So everyone ends their year better as an investor, generally long. The street, the buy side, hedge funds, money managers, pension funds, end the year in a better position. They're generally long. So December generally becomes a quiet month. And you get a lot of guys, a lot of the decision makers, take the time and they're off halfway through the month. They're gone. The desks are skeleton crews and pretty quiet. So across the board, it's a quieter month. I think we saw some of what we saw in November was kind of like tax loss selling earlier than expected. We saw that little move down on some valuation concerns, but nothing huge. And I think we see very little as far as overall price movement in the S&P from the current levels. I think we'll see some volatility back and forth. It just seems to be where the stock market's positioned. But that volatility, I think, leads to ultimately prices flat to where we are now to slightly higher. So we're on the front month of December. E-minis right now, 68, 62. I think between here and 7,000 would be, my target for the year end. But I've been talking about 7,000 as a year end target for about 2 months now. So.
Yeah, one of the things I always get such a kick out of, because I have a dark sense of humor, I guess, is when I see these different, on FinTwit, you see these different folks talking about trading the calendar on margin. They're like, this is all you have to do, blah, blah, blah. And, they'll gain a few thousand followers for a few months. And then all of a sudden they get wiped out because, July went the opposite way it usually does, or December that year, or whatever the case may be. So, it's just funny how people are, they get so, I guess, myopic on these different strategies. Obviously, not what you do at Ascalon 6, but
no.
It is funny how people sometimes very religiously follow these trends, but we got to remember they're just trends, right? Yeah. This is not a guarantee. If it was, everybody would do it.
Yeah, these things for me, two things. The things for me are basically anecdotal pieces. If somebody wants to talk to me, I mean, there are guys that actually trade astrology. they trade the position of the
Oh
moon
my
and the stars.
gosh.
No, it's a real thing. I mean, when I was at the hedge fund at Hart's Capital, we had somebody come in and pitch us on a strategy where they were going to actually trade the position of the moon and the stars. And that determined whether they were long or short equity. So that's a real
Nuts.
thing. Seasonality. And I'll listen to anyone at least once and kind of treat it as anecdotal. There's a lot of models and ideas and strategies out there that I think are anecdotal. It's good to watch and listen to, and you give some time to. I'll give time to anything at least once and see if it's completely insane or not. But yeah, I remember that guy coming in with the astrology approach. So it is what it is. Everyone has their approach. If it works, great for me. If it works, I think of it more as a coincidence than actually a good strategy. But I don't know. We're talking about the Fed this week as we talk about all the different information and the different processing of the data points and what's going to happen in 26, what's going to happen in 27. And that's kind of the conversation for December every year. Like, what are we doing for the end of the year? And then what do we look like next year? We have our first graphic up. There was a post, and it kind of, for me, summed up kind of the concerns here. The Federal Reserve itself, it's getting to a point where it almost seems like it's the layers of the onion are just too thick. The Federal Reserve itself is, for all intents and purposes, well, it's a private bank. There's nothing federal about it. And the way they're interacting with the public, the banking, the politicians, the banks, the financial markets, it just seems to be very convoluted at this point, to put it very nicely. And it seems almost to be a deliberate guide to where those individuals think that we need to go, the market should go, labor should go, inflation should go. It doesn't seem like we're benefiting much from the Federal Reserve, is my broad stroke question. We have $38 trillion in U.S. debt. We pay $3 billion a day in interest to service that debt. To just put that in perspective quickly, the debt that the interest we pay on our debt is actually over half of our deficit spending. So if you call deficit spending around $2 trillion a year, which, by the way, is about 6% of GDP, which is insane. But if we have $2 trillion a year in deficit spending, about 1.2 trillion of that is actually servicing the debt. That's how insane that is. So if we look at the Fed, and the Fed is supposed to be our Federal Reserve, our central bank, and managing two things, full employment and pricing, right? Are they doing a good job? Seriously, what is their function supposed to be? What do you see them doing now? And specifically, as we move from rates that were higher, arguably for way too long politically, now we're coming down, and then we go from quantitative tightening to quantitative easing. That shift is a major shift. We've only seen that once before, I believe. What is the Fed's purpose, stated purpose? And then what are we seeing happening here? And in particular, QT to QE, what do you expect? Great
questions, Anthony. If you go back to when the Fed was actually created, 1913, it was billed as basically little more than a check clearinghouse. In other words, a way for banks to transfer funds between each other. So if I want to, let's say, I buy financial services from you, Anthony, right? And so I write you a check. You then take that check to your bank and you give it to the bank. And the bank says, okay, this is EJ Antoni's account. We're now going to send this to his bank, and that bank will transfer the money to us. And then we're going to put that money into your account. And this goes back to when everything's backed by gold. So you need to actually monitor who has what claims on what physical stockpiles of gold. And again, that was supposed to be a function of the Fed. It was going to be a check clearinghouse. It was supposed to manage those interbank transfers. And then when you had instances where a bank was short on cash, because we have a fractional reserve banking system, meaning banks don't actually keep your deposits, they lend them out to other people. Now you have multiple claims on the same dollar. So if multiple people want that dollar at the same time, you obviously have a problem. The bank can then go to the central bank, the Fed, the banker's bank, if you will, and get a loan. Okay. Where is the Fed going to get the money to provide that loan? Well, from other banks. That obviously raises the question of, well, what happens if all of the banks are trying to get loans at the same time. Because if you don't have a Fed and one bank needs a loan, they can just go to another bank, right? So there's really no need for the Fed unless you are in one of those situations where all the banks are looking for a loan at the same time. And in that instance, the Fed was designed to literally just create the money and give it out to the banks, which is obviously problematic from an inflation standpoint. You're increasing the amount of dollars in an economy without increasing the goods and services available for purchase. So it's the classic too many dollars chasing too few goods. The value of the dollar then goes down, which means prices everywhere start to rise. That was supposed to be countered, though, by the fact that once the banking crisis or whatever you're dealing with at the time, even if it's just regular seasonality, once a year, all the farms across the country need a ton of cash. And then once a year, they all get a ton of cash during harvest and are looking to deposit it somewhere. So the Fed was designed to smooth out these fluctuations. And just as you would have in these moments of huge dollar demand, the Fed would create a ton of money. When the dollar demand fell, the Fed was supposed to get all that money back and extinguish it. And back when you had a gold standard, there was a reasonable chance of that happening. But once the gold standard went away, the Fed no longer was shackled by that requirement anymore. So what does the Fed look like today? Because we've had a lot of changes from the original Federal Reserve Act in 1913 to today. Well, one of which is the thing I just mentioned. The gold reserve is the gold requirement rather is gone. There is no convertibility to your dollar anymore. In fact, even calling it a dollar is a leftover of a bygone era. People forget, Anthony, but a dollar is actually a weight. It's a unit of measurement. It tells you the weight of gold you can get in exchange for a piece of currency. It's kind of a transliteration of a European measurement called the thaler. And the thaler, again, was simply a defined weight of gold. So the original dollar was a certain weight of gold and a certain weight of silver. That's what a dollar was. Today, it's technically just a Federal Reserve note. It still says dollar on it, $1, $5, $100, whatever piece of paper you happen to have. But for all intents and purposes, it's just a Federal Reserve note because, again, there's no convertibility there. Okay, so that means the Fed can just print as many dollars as they want, right? And they used to actually have to physically print these things. Today, though, they just add a bunch of ones and zeros in a spreadsheet, and voila, they create money in different accounts. Another kind of real big, it's just a change. I'll just say it that way. Another big change has been the fact that banks don't actually have to keep anything in reserve anymore at the Fed. They do keep money parked in reserve, these bank reserves, but they're not required to. So what's the incentive to do it? We've talked about this a lot. It's the fact that the Fed now pays them interest to park that money there. In other words, this is money that banks are getting a return on. There's an ROI, right? They're getting a return, but they're not actually doing anything with it. There's literally zero risk. You're lending to an entity that can't go bankrupt because it can just print its own money. It's a guaranteed rate of return, and there's not even a what you could call a term premium, right? Because the Fed is not requiring you to park that money for any length of time. Just park it there overnight, and if you want it tomorrow, you get it right back. So there's no risk premium. There's no term premium. It's just free money for the banks. It's another really big change. And then also another considerable one, although it's been around for a very long time, this was a change that happened under FDR, is who actually sits on the voting board at the Fed. In other words, the group of 12 people that actually set policy. It used to be a majority of them were heads of the different regional banks, the 12 regional banks around the country. But FDR flipped that on its head. So now I think it's 7 members of the FOMC, Federal Open Market Committee, the ones who actually set Fed policy, who do things like quantitative tightening, quantitative easing, which we'll get to in a second here. A majority of them are now on the board in DC, and a minority are a group of rotating members of the presidents at the different regional Federal Reserve banks. In other words, even if all the Federal Reserve banks across the country want to do policy X, they have so few people on the board that the people here in DC can say, no, we're going to do Y instead. And that's a complete difference from how it was, the system was originally set up and how it was originally sold to the American people. So now they can make decisions on things like quantitative easing or quantitative tightening, which is really just a euphemism. It means in the case of tightening, that's extinguishing money. In the case of easing, that's creating money.
So that's kind of where we are now, not to interrupt you, but that's kind of the shift. That's a perfect shift. So we have a situation now where, again, is the Fed sticking to the original mandate and process and procedure or not? And I would argue not now, as we go from quantitative tightening, this quantitative QT to QE cycle and flip that they've engaged in for now, the past 20 years, right? Just coming out. This really started coming out of the financial crisis, right? This as a tool in the toolbox. Right. I like how we say that the toolbox keeps growing beyond and beyond.
Yeah.
So right now we're at a position where we are shifting from quantitative tightening to quantitative easing. So the tightening would be they're selling assets, treasuries off the balance sheet. They're taking money in, so reducing the amount of liquidity in the market. Yeah. And this is my simple way of thinking about it. I know it's far beyond this.
No, you're right. You're right.
Easing. All right, so they've now drained the balance sheet. There's nothing else to sell. They need to start buying assets. And then the easing part is that they're actually adding dollars liquidity back into the market because they have to pay for what they're buying for. This shift, what's going on now, it's very significant. December 1st was actually the official end of QT. Where are we now, and why is this so significant?
Well, right now we have basically where the financial system stands right now, and it's all about the financial plumbing. Is that we're just kind of on the edge. We're right on a tipping point. It's not like we're in a tipping point into disaster. We're just in a tipping point into a place where the Fed doesn't want to go. So let's back up to the financial crisis that you just mentioned to try to get a feel for what is the dynamic in the financial market right now. What happened back then was the government was literally spending so much money, there was no way to absorb it all in the financial system. It couldn't do it. And so you were going to have treasury yields, for example, just go through the roof. I mean, double digits easy on whether it's the 2, the 10-year, the 30-year bond, any of those. Even bills were going to probably hit double digits. And so the Fed, people at the Fed got together and said, okay, what can we do to help absorb all this treasury issuance that's coming down the pike here? They said, well, if all we do is just buy the bonds, right, from the private sector in the secondary market so that the primary market can then go back and buy more. All that money is just going to go right into the banking system. And now the banks are going to lend it out, fractional reserve, like we were talking about earlier. Yeah. And so every $1 of treasuries we buy is going to end up creating $10 in the real economy. That's going to be a disaster. It will be runaway inflation. So they came up with this idea of what if we figured out a way to prevent the short circuit, if you will, the fractional reserve part. We're going to prevent the banks from loaning out the money that we create for the Treasury to spend. And they did that by saying to the banks, look, you have this amount of money you have to keep in reserve. That's your requirement. We're going to pay you interest if you keep more than that, though. This was the interest on excess reserves, as it was called at the time. And the Fed had to essentially keep paying banks interest to keep that money parked at the Fed in order to prevent it getting out into the real economy. And it worked. It worked actually better than any of them thought it would in terms of, again, preventing that inflation. The big problem, though, was the fact that you tied up literally trillions of dollars in private capital. It sat idle at the banks and couldn't be lent out. And that was a big reason why we had such terrible economic growth under Obama. It wasn't just the bad fiscal policies, although it's certainly that was true, but it was the bad monetary policies too. And then basically once Trump gets into office, the Fed decides, all right, we need to start reversing course. And it's going to be very, very painful. And this is why the Trump economic miracle was such a miracle. It was the fact that while Trump was in office, 2017, 2018, and towards the end of 2019, the Fed was hiking rates and selling off the balance sheet, extinguishing money, which was, again, very, very painful. And what happens in the fall of 2019 is we actually get a miniature financial crisis. Yeah. And the Fed has to conduct a $500 billion bailout of leveraged hedge funds. And that was still ongoing in March of 2020, but then COVID hit and everyone forgot about it. Yeah. So what the big blow up in the autumn of 2020, Anthony, was that the framework, the new monetary framework that the Fed had built, required bank reserves to be at an artificially high level, because banks could choose to either keep the money parked with the Fed or lend it out to the private market. And now with that extra demand on cash, it's not just the normal route. They have a second option there. You now automatically need excess liquidity to prevent the one from getting starved. And the level of liquidity dropped too low. And that's where all of these leveraged trades completely blew up. And the Fed was afraid that we could have another financial crisis here. So they stepped in a big way. But then COVID hits and the Fed goes just balls out. And they say, we're going to put trillions of dollars into the financial system. They virtually double the balance sheet in a very short period of time. So they create trillions upon trillions of dollars. They buy up every asset they can, good or bad, doesn't matter. They put rates down to zero. And then they tell the banks, we're not just going to pay you interest on excess reserves. We're going to pay you interest on all reserves, and you're not required to keep anything in reserve anymore. So they put the previous system on steroids, and it made all of the problems from that even worse. So it just amplified all the symptoms, right? One of the ways in which they were absorbing that excess liquidity, though, after COVID, and this is something we've talked about a lot, was reverse repos, where you can either keep money parked in reserve at the Fed, or you can loan it out to the Fed via these reverse repurchase agreements. And those reverse repurchase agreements have essentially been completely drained. It peaked at over $2.5 trillion. It's down to effectively zero. It's a couple $2 billion a day now, which is literally a rounding error at the Fed. So that's been completely drained. At the same time, bank reserves have been dropping. That represents another drain. What all of this meant was that banks were, the financial plumbing was basically running dry. It prompted the Fed to stop selling off the balance sheet, to end QT. And now what we're seeing is kind of the financial market waffling back and forth, where one day you'll have a few $1 billion in reverse repos. Other days you'll have a few $1 billion in regular repos, which is a way for the Fed to temporarily inject liquidity. But if the Fed is constantly needing to temporarily inject liquidity, that means the financial system is requiring a permanent injection of liquidity. And that is what QE represents. And so what we're looking at today is a foreshadowing of the market forcing the Fed's hand, saying, look, the current levels of liquidity are not enough. We're going to have to inject more. And part of the irony here is the fact that every time they cut rates, interest rates, they're reducing the incentive that banks have to keep money parked at the Fed. And the Fed wants money parked at the Fed, right? They have these artificial requirements where they want bank reserves to be. And so if they cut rates, banks have less of an incentive. And so the irony here, and this is the last thing I'll say, because I know I'm going off on a lot of tangents here.
Right.
But what the Fed may actually end up being forced to do, because they've painted themselves into such a corner, is simultaneously buying bonds while hiking interest rates, stomping on the gas and the brake at the exact same time. That is an absolute recipe for disaster. It gives you all of the anti-growth incentives along with all of the pro-inflation incentives at the same time.
Okay. So this is definitely, that's a phenomenal deep dive into the Fed functionality, balance sheet, rates, QT, QE, and the previous disasters that were created and or barely avoided, and where we're heading now. I think that's as usual fantastic. All right, everyone, that was part one of this episode of this week's Policy and Profits. Such a good episode, chock full of information. We're going to keep that as part one. We're going to have part two tomorrow, where we shift to the markets and the policy side. We'll see you then.